All right, guys, I got three charts that have me concerned about the market. We went over this with the membership in our class this week and our class last week. Let's start with a bit of a long-term chart on the Nasdaq futures, taking you back to 2018. Now, what we have here, these are IV bands, implied volatility bands of the Nasdaq, and then this is going to be the actual Nasdaq. Market makers are very, very good at pricing volatility. I was a market maker for 5 years. Trust me on this one. So you'll see the implied volatility bands for 2018, 2019, 2020, 2021. Volatility during the pandemic. That's why 2020 was so crazy. That's why 2021 started out pretty much at a low volatility level, has been working its way, volatility lower, right? The VIX has gone from 30, 25, 18. It's just started to go back out again. Now let's talk about the market. Let's talk about the QQQs, because the market is going to recognize its implied volatility bands. Going back to 2018, you can see rally, 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 gets right up to the bands and then sells off. 2019, market rallies, comes off a little bit, rallies really strong all year, right at the top of its bands, and then it outperforms, gets very, very expensive going into the next year. Not surprising. The next year, a big sell-off, a big spike in volatility that happened to be COVID as well. Then the market rallies right up to its implied bands before it sells off once again. Rallies, outperforms its implied bands. What do we expect to happen? Well, I personally expect the Nasdaq to fall off after this kind of behavior. So let's use Equity Edge again. Same thing, but now we went with the live chart and I switched it to a monthly. So instead of looking at the annual with the same implied bands, here's the market. We're looking at a monthly and I put it on a 1 hour chart. Now, when we do this, just like the annual that we were just looking at, each month is a separate study. So this chart, going back to January 1st, 2021, there's one study, the first month, January, February, March, April, and May. So again, January, low vol, it starts picking up a little bit. Then volatility comes in going into February. February, really not much going on. When there's not much going on, the market is a little volatile here. Market sells off. Then volatility starts to come in. When volatility comes in, when it gets lower, the market's going to rally. Rally, rally, rally. Rallies up to its implied bands. Fails. Rally, fall, rally, rally. Going into the next month, sells off. So we're seeing it in the annual. We're seeing it in the monthly. This will be the second chart. That was actually just the first chart with two subcharts. Here we're going to look at the QQQs. Looking on a daily chart, going back, about a year and a half. What we have here is the historical moving average of volatility. So it's historical volatility. It's a 21-day moving average. And then we have 3 standard deviation bands, 4 standard deviation bands, 3 standard deviation, 4 standard deviation. On a daily, we get buy signals and sell signals, and we are getting sell signals right up here. So that's the second chart. Now we got a third. Risks are elevated. Again, we're on a daily. We're looking at VIX futures, the same high value target tool that uses 21-day historical volatility not only gets a buy signal, gets the back-to-back buy signal. This is suggesting that the VIX goes higher, as it has. When the VIX goes higher, naturally, the overall market's going to go lower. They're just saying there's more risks in the market. Risks are elevated, a higher probability to go down. When the market rallies, volatility goes lower because everything's lovely up top. My name is Jonathan Rose. I'm the owner of Masters in Trading.